All right, so let's welcome back. Welcome back. Now we're gonna go to the next session again. The 1 minute is the 2 minutes. Hey, listen. This is you can take as long as you want. That's up to you. Okay, this thing is being recorded after I posted. Hey, it's okay. You can take as long as you want. It's up to you. Right now, we just gonna give you little short breaks because I gotta get to this material because there's a lot of information for me to cover here with you. So I'm gonna go ahead and do my best again. Let's get back to work. My name is EJ, always, aka EJ, always known as Ernest. I'm not gonna say the last name. It's all right. All right, let's get back to work. So we did, if you watched the previous session, so he was talking about whole life. I mean, term insurance, my bad. Now we're gonna talk about the whole life now. This is the part that there is more to this one, so we're gonna take a little bit longer. So now we're gonna talk about whole life insurance. Let's start with this session. Can you guys, let me make sure that you guys see this screen. I hope you do. Yes, I do. I can see it. So we're going to talk about session B here, traditional whole life products. I want you to understand, if I don't want to say whole life on your notes, another name for whole life is permanent. You can see it right here. Permanent. That's to put that down. A whole life, it can be permanent. Okay? Another name for whole life, it can, what we call cash value. Cash value. I pointed out. Cash value. So those are the names they can use for a whole life. So for example, if you go in the test question, they're talking about so and so purchase a cash value life insurance. Come on, you don't need to. Don't try to even mention the term insurance, folks. It already tell you it's a cash value. That means whole life. Once you know some characteristic of a whole life, you'll be good to go. Okay, why do they call it a whole life? It's because it lasts for a whole life. Okay, I do not understand what that means. But what do I mean in terms of that? It's called until you die or you live until age 100. So if you buy a whole life insurance, that means this policy going to last you to age 100. This is for the test world. It can be different out there, but that's for the test world. To age 100. That's what make it whole life. It's going to last, the coverage going to last until age 100. Put on your notes. If it is a whole life insurance, there is cash value. A whole life insurance provide lifetime. You see? Lifetime protection. And it include a savings element. That means there is a saving attached to it. And that's all what we call cash value. If I ask you, what does the saving elements refer into a whole life insurance? It refers to the cash value. Okay? So whole life policy endows. Remember we explained that. Endows. So for now, I'm not talking to it for everybody. Because for you that smarty pants, that's no English better than I do, you already know what endow means. So this is not for you. Okay? For my people who speak second language, endow mean, okay? Terminates. It's done. Endow. If you take O-W out, what left? End. E-N-D. What end mean? Finish. Terminate. See it? E-N-D mean end. But endowment, that's mean terminate. The policy is mature. So that's mean the policy end at age 100. For you people that came from a different language, I know your pain because I used to be in that pain too. Because that exam maybe sucked me dry. That exam tried to drive me crazy. Because too many words in English. That's why we don't like English that much. Okay, I prefer some other languages. But English is too complicated. Too many words. Okay? So, alright. So, it's endowed at age 100. So, that's the characteristic of a whole life. It's going to end at age 100. Which means the cash value, okay, creates, okay, the cash value that created by the accumulation of the premium accumulation, when you accumulate that premium every time, it's going to equal the face amount. Okay, now let me explain this because you not get that. Let's say that right now I'm 35 years old, for example. I'm not with 35, I'm just kidding. Okay, I'm 35 years old. If I buy a whole life policy, and let's say I'm paying $100 a month for $150,000. Okay, get this. I'm 35, buying a whole life. I'm paying $100 a month for $150,000. Okay? So if I live to age 100, the cash value going to equal to the face amount. So that's mean the cash value going to have 100,000, 150,000, and the face amount is already 150,000. So that's mean the cash value going to equal to the face amount. That's what that means. At age 100. When it's going to happen like that? Age 100. Not 80, not 90, age 100. The cash value and the face amount will be equal if you get to live that long. And I wish you success. Hopefully at that time you know what money means to you. But anyway, okay, beyond this point, I should not even say that. No, take this back. But anyway, it's just fun. But whatever. They may not like that, because if I say like that, they might say I like the term better, whatever. I don't care anyway, whatever they think. Anyway, but so oh my goodness, the policy premium is calculated. Okay, that the policy. I know at the end what you're gonna say. You're gonna say at the end. I know what some of you guys are gonna say. At the end, you say I don't like none of those. I know, but it's okay. Just relax, fasten your seatbelt. You try to pass this exam, okay? Now, the policy premium is calculated assuming that the policy owner will pay the premium until what age? 100. Okay? The premium for whole life policy usually are, we see, higher than the term, because a whole life is more expensive than a term insurance. Okay? So you know. So now you know some characteristic. A whole life, if I don't want to say whole life, I say permanent. Or I can say it's a cash value. It's going to be finished at age 100. That's when I can pay all the way to age 100. Now, if it is a whole life, it builds cash value. Put on your notes. Any whole life insurance builds cash value. Remember? Any term builds no cash value. But any whole life insurance builds cash value. Because that's what makes it a whole life. Okay? Now, the following are the key characteristics of a whole life insurance. You got a level premium, just like a level term. You have a level premium. What does level mean? Premium doesn't change. The premium of a whole life, it does not change. Okay? It's still going to be based on the attained age. Therefore, it remains the same. I tell you, it remains the same through the life of the policy. The next thing is the death benefits. This is the death benefits. I can say death benefits. I can say proceed. Let me type the proceed for you. Or if somebody can type it out. There was the chat room. Come on. Where did you go? Proceed is P-R-O, for people who's listening, P-R-O-C-E-D. Proceed. It's mean death benefits. It's mean that's what your beneficiary going to get. That's the coverage. Or you mean it's the coverage. That's the coverage. Okay? That's the contract coverage. That's what you get. That's what the contract say you're going to have. All this word mean the same thing. Okay? That's what you're going to, the policy going to settle for. That's the settlement amount. Okay? So the death benefits, it's guaranteed and also remain level for life. So when you buy a whole life policy, the death benefit is guaranteed. Okay? For the remaining of life of the person. Cash value. The cash value created by the accumulation of the premium. As you making your premium payment, that's when the cash value start build up inside that policy. Usually, depending on the type, it take like 3 years to build cash value. Okay? Usually it take like 3 years. Okay, that's mean the first year you may not see any cash value. The second year you may not see any cash value. Okay, depending on your age, it might take 3 years. Depending on your age, it can take 1 year. Okay, but for the test purposes, most likely the right answer probably 3 years. Except if it is a single premium whole life, that's different. I'm going to explain that in a minute. Living benefits. What does that mean, living benefits? The policy owner, I did not explain this. If you didn't have a chance, go watch the first chapter. Okay? You're going to learn about the policy owner as well. Policy owner is the person who buy the policy. That person have the control. They can cancel the policy. They can change the beneficiary. They can take a policy loan. They can L.E. The beneficiary that's been révoqué, remplacer immédiatement. If you don't speak Creole, forget that. This is just joke. I'm sorry. Okay, that's mean if you are the policy owner, that's mean you can just revoke that person and you can put another beneficiary. But there's an exception to the rule. I'll explain that maybe if I got time later on into another section. You can borrow against it. Okay, you can receive the cash value. Okay, you can surrender. When you see the word surrender here, surrender. When you surrender something, that's when you stop it. It's just like you tell the company, listen, I don't want this policy anymore. Surrender it. Give me my money back. They might give you some. I don't know. That depends. What if there is any? Surrender mean that's when you say like I'm gonna stop the policy. I'm cancel the policy. The cash value, also called non-forfeiture value. That's another word you have to know. Non-forfeiture mean not giving up. What you're not going to give up. If there is a whole life, non-forfeit mean I'm not going to give up my cash value if I'm going to surrender the policy. If I don't pay, if I have a whole life, I got money in the savings, so I'm not going to forfeit that for the insurance company. I'm not going to just give that money to the insurance company. They have to give me choices. That's why you have to go to chapter 3. Then you're going to learn about the non-forfeiture option. There is 3 for your information here. There's extended term, reduce paid up, cash. There's only 3 non-forfeiture options. And that's in chapter 3. So if there is a whole life, listen to me now. Any whole life insurance have to give you non-forfeiture option. They got to. Any policy that contain cash value, they have to give you the non-forfeiture option. They have no choice. It's required by law. They have to give you the option. How do I take my cash value? If there is cash value, how do I take it? Because it's my money. Okay, I need it and I need it now. How do I take it? They have to give you the non-forfeiture option. Does not usually accumulate until the third policy. Okay, see, I told you that already. Usually it does not accumulate until what? The third policy year. He grow when? Okay, that's another note. How does the cash value grow? Tax deferred. That's when you do not pay taxes on the cash value. It grow tax deferred. So that's mean, oh, that could be a test question. That's mean, let's say I purchase a whole life policy. Let's say that for the time that I paid for, like, let's say I paid for 10 years. And I paid $5,000. Okay? Then I decided after the 10 years, I don't want the policy anymore. I want to surrender it. I want to cancel it. I want my $5,000 back. So when I called the insurance company, say I want to cancel, they said, well, I asked them, how much money do I have in my cash value? They said, well, sir, you got $6,000. Okay, so how much do I say I paid? $5,000. But they say I got $6,000. Why? Because it grow tax deferred. That means my cash value can also grow. It can also make me more money. It can also make me less money. But if you make me money, that's called tax deferred. That means as long as that money sit in the policy, you don't pay taxes on it. How do you pay taxes on it? Now, if I cancel it, I say I want to cancel, and they send me $6,000, okay? That's when I make a profit of $1,000. So the $1,000 was going inside the policy tax deferred. Now, because I take the $6,000, I have to pay taxes on the $1,000. Why I don't pay taxes on the other $5,000? because that's the premium that I already pay taxes on. That's money that I take from my bank account that I already pay taxes on. Then I'm paying the premium. So therefore, the 5,000 is not taxable, but the extra is taxable. Now, this is how you answer the question. You put that in your notes. The difference between the cash value is taxable. The difference between the cash value is taxable as ordinary income. The difference is taxable as ordinary income. The difference is taxable as ordinary income. So that's mean the $1,000 will tax, fully tax as ordinary income. All right. That's enough. Know this. Whole life insurance provide lifetime, what we call permanent protection, and it also accumulates cash value. Now there's three types of whole life. There's more, but there's three main types that I'm gonna talk about. I'm gonna talk about the rest in a minute. Those three, this is what most people have. There's three types of main basics. Okay, three basics one. You're gonna find what we call whole life. That's a regular whole life policy. What we call a straight life, a straight whole life. Now that's another word you have to know on your vocabulary. Straight mean level. Do not change. It's fixed. A straight life. Remember, in the term policy, the level term, nothing change. Same thing in the straight life, nothing change. The premium is level, the death benefit is level for life. It's a straight life. Limited pay whole life. That's the second one. Okay, what does the word limited mean? If you see that word, come on, folks. Let's just come in really common sense. Those things here. Limited. Let me put that down. Limited on the chat room. Limited. What does limited mean? That means there is a limit, but a limit for what? To pay. To pay what? The premium. You get that? Limited pay, that means there is a limit to pay what? The premium. So that means in this type of policy, you don't pay the premium to age 100. Even though it's a whole life, but they only pay the premium for a period of time. After that, you don't have to make any more payment, but guess what? You still have to hold the policy until age 100. That doesn't mean because you're done paying it, that doesn't mean they're going to pay you the death benefits. That ain't going to happen. Okay? The other one, single premium. What does single mean? Explain that to me. What does single mean? Single mean one. One what? One payment. When? At the inception. See, that's how you get this. See, when I have a single premium whole life, that's not make only one payment, a big lump sum, one time, no more payment. But that because it's a single premium whole life, it builds cash value immediately. So put that in your notes. I'm gonna put that down. Single premium WH for whole life. Okay, single premium whole life pays only one payment. Only one payment, and it builds cash value. Cash value immediately. Okay? That's it. That's the single. It's still a whole life. You make one payment, one time, but you're going to build cash value right away. Why? Because you don't owe the insurance company money. You give them all the money at once. Now, I'm not saying this is a bad idea, but that's really, excuse me, that's a dumb. Why would I do that? If I know a better thing to do, I'm going to take my money, just give it to you. Man, you're going to get to see some people, okay? Some people. That you know what? I want to show everybody that my policy, I have a policy, I already done paying it. It done pay for. But soccer, you can take the money until you die anyway. You just paid, but you can't get the money. You just have a policy. You just give the insurance company. Why we make that? Why we make that? Is that the question? Why we make that? Why do they make that? Because the insurance company say, listen, if you give me that money right now, because you know nothing to do with it, so give it to me. I'm gonna go make a ton of money with it anyway. Hopefully, you live for a long time to age 100. At a time, I'll not mind paying that money because you give me all that money up front. What are you gonna do? Invest it. They're going to invest it. What do you mean? You give me, for example, let's say that somebody played the lottery, and that person get from is a poor guy, didn't know anything about money, and then just take a quick pick or is a scratch off or whatever that soccer. Me, I don't play that lottery, so because I mentioned that, don't go play. Okay, I don't play that soccer anyway. Okay, so let's say that person go play, and let's say that person win, let's say $5, $10, $20 million. Okay, and then now because he doesn't understand too much about money. And then since he don't know too much about it, he said, listen, since I already have so much money now, I want to make sure I take care of my funeral now. Excuse me. Let me go ahead call the insurance company, okay? And I just buy a policy as a single premium. I just give them from the all that money that I have, I give them $100,000, okay? And then they can cover me maybe for 150 or maybe 150,000 or maybe 250. I just pay them one lump sum. I just give them $100,000 from that money. Okay, that's smart, very smart. How you you have all that money, and you could do something like this. Okay, but anyway, some people might do that, and after that they can say, oh, man, hey, listen, they start telling you different. Hey, Joe, you don't know, man. You know what I just did, bro? Listen, I just hit the lottery, bro. Hey, listen, I got some money. I already have a policy that paid for, baby. I just gave him $100,000, and then now my policy is covered for life. And then Joe say, yeah, you smart. Why you didn't give me that $100,000? I could have opened a business. I could have given you some interest rate. At least we could have given you some more money, okay, while you're living, because you can get that money. Because the insurance company gonna hold you until you die or 100. Did you know that? Dude, you didn't know that? Huh? Oh, is that what they're gonna do? Yeah. He's really smart. They're very smart. Smarty pants. Okay? But anyway, let's talk about them. Ordinary whole life. Let's talk about that. Ordinary. That's mean, when you see the word ordinary, it means straight life. Ordinary, that's mean you're not extraordinary. Okay, that's what everybody got. Ordinary mean that's normal. That's the average. Most people you are. Okay, so just give them that one. Just give them that one. You ordinary. Hey, listen, I explain this to you like that. You just to make fun of it. Okay, don't feel bad because I just say it that way. Okay, ordinary whole life. That's mean ordinary mean is not extraordinary. That's what most people is the basics. That's the first one. Matter of fact, most people that's what they have. Most people, that's what they have. It's straight life. When it's ordinary life, look at this picture here. The face amount is level. That's what that is. Okay? The face amount is level. That's when the face doesn't change. Okay? The premium doesn't change. If you have this type of policy and you live into age 100, that's when you're going to pay the premium until age 100. Okay? The premium will not change. Now, the cash value, see, that's the first year, no money. Second year, no money. Until the third year, that's what you see this go like this. And the third year, you're going to start seeing cash value. You see how the cash value, that's the bar. The cash value start right here. Where you see what happened. It meet right here at the corner here with the face amount. So, if you live to age 100, the cash value equal with the face amount, but you cannot get both. Your beneficiary only can get one deal. So if you have this policy for $100,000 and you die in the middle, let's say by age 80 and you die, Let's say you cover for 100 grand, remember? Let's say at age 80, you have another $70,000 inside the cash value. So if you die at age 80, they should give your family 100,000 plus they should give them this 70,000. But the insurance company say, no, 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 that's not how it works. That's not how it works, Tipapa. This is okay. You can only get the death benefits. You cannot get the 70,000. You ask who get it. The insurance company keeps it, but they charge you for both. Yeah, Tipapa, that's how it works. And they say, yeah, 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 that's how it works. I'm sorry, I should not laugh. I should not It's not funny. I'm so sorry to let me get some water. I'm so sorry. I should not be laughing like that. I should not. But it's the real deal. It is the real deal. But anyway, so that's what happened. That's exactly what happened. So it's straight life. You pay that sucker all the way. They call it continuous whole life. You paid all the way to age 100. Okay? But if you die before age 100, your family gonna get the benefits. Don't get me wrong. But now, what happens if you live to age 100? If you live to age 100, I think the insurance company at some point they're not being fair at all. I'm so sorry. Poor guy, come on. You live to age 100. Wouldn't it make sense for the insurance company to say, since you win, you live to age 100, that should give you the death benefits and the cash value. At least that would make sense. Listen, I promise you, if that's how it works, man, that would be the best product ever written. But that's not how it works. Okay? That's not how it works. So why do I explain this thing to you? I want you to get this. So in order for you to get this money, it's either you die before age 100 or you get to live to age 100. That's the only way you win. Same thing with the term. That you see the term insurance? That sucker, once the 10 is done, you get nothing. Zero. Okay? The insurance company went on you. Listen, it's a fair game. When you're buying insurance, folks, you have to understand. It's a buy and you win some, you lose some. Okay? I have clients who died. Okay? I have a client that just, matter of fact, just passed away. Okay? The company have to pay that. Okay? That's a win for the client. Okay? Even though the client died, that's a win for the family. It was not their fault they passed away. Things happen. But at the same time, I think it will be fair. I just my opinion. For somebody to live to age 100, that's a big deal. And the insurance company, you should have shame on you. You should have given them the 100, both the cash value and the death. But anyway, that's how it works. All right, that's done with that. Done with that. Done with that. Okay, let's go to the next one. Limited pay. Limited pay whole life. Limited pay, I would explain that to you. Okay? Now, this is what you write down. A limited pay, it is still a whole life. Okay? Look at the diagram. Do you see how the premium limited, you see how they give you a limit? Paid up. That's when you're done paying it. Okay? Even though when you're done paying that premium here, that doesn't mean they're going to give you the money. No, you're going to still have to live until age 100. Or you die before that. That doesn't mean you're done paying it. Okay? For example, it's just like, I know this is not really realistic, but I'm going to explain that. Like that. Think of it just like you buy a house and you make the mortgage for 30 years. After you're done paying for 30 years, after you're done, the mortgage company, after the 30 years, okay, you done paying them. And the mortgage company say, listen, I know you done paying us for 30 years, but at the end of the day, the house still not really yours until you get to age 100. You paid them for the 30 years, but the mortgage company say, no, 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 no. I know you done paying, okay? You can stay there, no problem, okay? But guess what? The house is still not yours because you don't live to 100 yet. It's when you get to live to 100, that's when the house become yours. How would you feel about this? Not great. But at the end of the day, this is how limited pay works. It's just the payment done. Okay, they pay you until you pay the premium every month until that time they give you. Now, here's what you got to write down. You see, they call it 20 pay. If you say 20 pay, that's when you're going to pay it for 20 years. Think of it this way. When you see 20 pay, it's still limit. They give you a limit. 20 pay, that's in for 20 years. That's still a limited pay. So on the test question, if there's, excuse me, let's say that they say somebody buy a policy and it's a 20 pay whole life. What does that mean? What kind of policy they purchase? The simple answer you should pick is limited pay. Okay? Let's say they say somebody purchase a policy. Life paid about age 65. That's when they give them a limit to pay. Life paid about age 65. They're referring to the limited pay. That's still a whole life. Okay? So the whole life, that is cash value. But what happened? If you have the limited pay and the straight life, the limited pay build cash value faster than the straight life. The straight life take like about 3 years, but the limited pay gonna build cash value a little bit faster because you're done paying the premium faster. Okay? That's the limited pay. Limited pay, that's mean you have to make the payment for the rest of your life. Okay? Can we make a withdrawal before we get to age 100? No, you can borrow against the cash value. You cannot make a withdrawal. You can borrow against it. And when you borrow money against your policy, remember, it's going to affect your face amount. You no longer cover for the same face amount. Whatever you borrow, the face amount goes down by that amount. For example, if you cover for 50,000 and you borrow 10,000, you no longer cover for 50,000. Now your policy reduced to 40,000 and you have to pay that $10,000 back plus interest. And if you don't pay it back, the policy will be terminated. And when your people know you got insurance, that's when they call the company and they're gonna find out, oh no. And guess what? Your dad or your mom get a loan long time ago for 10,000, but he never repay us. So we terminate the policy long time. So therefore you have no insurance. Okay? Alright. Okay, why do we have the cash value then if we only can borrow? Is a way to trick people to buy that sucker. Is a way to trick you to buy it, to make it sound it's a great investment. They say it's a good investment. It's not no investment. Okay, it's just a way to trick you to buy it. Right now I can teach that because right now I'm teaching the class. So if somebody you're selling that, I apologize. I'm just explaining the way it works. I'm sorry. If you get mad, it's okay. This is how it works. And if it's not, you can go ahead, comment in the video, tell me, Ernest, you're lying. That's not how this sucker works. Good. All right. But anyway, it's still going to last until age 100. It's still build cash value. Okay? But you see, cash value build up faster than the limited pay. Okay? Faster than what? Than the straight life. Okay, so this is it. The last one that we're going to talk here is what we call a single premium. You see, look in the red dot. Okay? And the red dot here, you're going to see a single premium. That's the one that we were talking about. So now, also, what I want you to also understand, when somebody do a reduce paid up, when somebody, let me type this for you. A reduce paid up non-forfeiture option. Reduce paid up. If you do a reduce paid up, that's equal to a single premium whole life. So this is one of the non-forfeiture options. When somebody do it, that's still a whole life. It's a reduced paid up. It's still a single premium. So a reduced paid up turn to a single premium. That means it's somebody who have a policy after like maybe 10, 20 years. They don't want to cancel. They still want coverage. But they don't want to make the payment anymore. So what they call the insurance company, they say, listen, since I got $10,000 into my cash value, I don't want to make any more payment. Because this policy really kicking my butt right now. Because I don't have a lot of money, because I'm retired. Things expensive. There's no way I can make payment anymore. So can I do a reduce paid up if you know that term? Or maybe I say, what can I do? And they give you 3 options. Okay, and this is one of them. So if you choose this option, the reduce paid up. Okay, let me put it on this screen so people can see it. I hope you can see it now. Okay, if you do that reduce paid up. Oh no, you can't see it. Why you can't see it? Why? If you do the reduce paid up, oh, I don't know what. Yeah, you should be able to see it, but I don't know why you don't see it. I don't know, but I try. Okay, if you do that reduce paid up, for example, since in the chat room, that's why you can see it anyway. So if you do that reduce paid up, go check in the chat room, you will see it. That's a single premium whole life. So the person said, you know what, I don't want to hold this policy anymore. So they do a reduce paid up. What happened now? If they cover for 50,000 and you do a reduce paid up, what does reduce paid up mean? If it is reduced, you can see what happens. Something getting decreased, reduce, goes down. But what getting reduced? The death benefits. So you no longer cover for 50,000. Okay? So they're gonna give you a reduced paid up based on the amount of the $10,000 can purchase. Because remember, inside the policy you have $10,000 cash value, $10,000. So they're gonna use it to buy a single premium policy for you as a reduced paid up. But they're gonna use it as one single. They're gonna take it, the whole amount, the whole cash value. They're gonna buy one policy. One time, they'll make one payment. But as a reduced, you no longer cover for 50. Now the $10,000 can purchase, let's say, 20,000. So now you no longer cover for 50,000. You cover for 20,000 because this is why the $10,000 can buy for the rest of your life. So that's a reduced paid up. It's still a whole life. Now you buy it as a single premium. Now single premium, it's also, remember, it builds cash value immediate. So if somebody have a reduced paid up, the cash value will increase. So that's mean cash value will increase into a reduced paid up. And you see paid up is not paid up. It's past tense, paid. That's when the policy is already paid for. Paid, not pay. Paid up. There's a difference. You see this one? You see how this one said paid? That's when it's paid up. That's when at 65 you'll be done paying it. Okay? Now 20 pay is different. You see 20 pay? That's pay. That's still in the present. That's when you're still paying it. But at 65, it'll be paid. That's when you'll be done paying it. So a reduced paid up, that's when that policy is done paid for. But it's still a single premium whole life. It's gonna last until age 100. Okay? So in this picture, that's what you see. That's what happened. You see now the different. You see, you make one single premium. Now the cash value start increase right away. But you're still gonna have to live until age 100. You just save a policy that pay for, but you can't get it. You got to be dead. So for example, imagine somebody who's 30 years old and you get this policy. You cannot use that money until age 100. Unless if you die before that, your beneficiary will be happy to collect it. But if you have to use that money yourself, it's either you borrow against it or you have to, even though you just give it to them, you have to borrow against it. You know, I was doing a seminar with a group of people. Do you know, folks, the person, they take money, their own money, they add to the cash value so they can build cash value faster. Man, when people don't have the education, they can really make some serious mistake. It's unbelievable. All right? So that's a single premium whole life. Single premium whole life. That's what that means. SPW. That means single premium whole life. It's still gonna last until age 100. You make premium one time as a lump sum. And the policy completely paid up in one premium, but it generates immediate cash value. That's a single premium whole life. So now, that's the difference. You can see I highlight that for you. If you want, when you're watching this, you can post it. You can see the type of protection. There is temporary. That's what we refer to the term. And you can see whole life. That's how we turn to permanent or until age 100, what we call cash value. Premium, how does the premium works? Level in the term, level on the whole life. Death benefits, level on the term, it can be increasing, it can be decreasing term. But on the whole life, it's level. It's level. Living benefits, there is none available. When talking about living benefit, that's when there is no cash value on the term. Remember? There is no cash value. That's why there is no living benefit, not available. But on the whole life, there is cash value. There is policy loan. Okay, policy loan, that's when you can borrow against it. Non-forfeiture option. Okay, non-forfeiture value. That's mean the non-forfeiture, that's mean the cash value you can use in order for you if you have an emergency. So that's what you need to know on that part. Okay, so now we're gonna continue because there is some other more a whole life we have to discuss here with you. There is some other thing called interest sensitive or market sensitive and adjustable life product. Those are still whole life. But what happened is the insurance companies, what they do, in order for them to compete, they say, let's create another product that attached to the market. So they come with more whole life to confuse more people. Okay? To get even make it more beautiful. I should not say confuse people, but it is in a sense. But anyway, whatever. To confuse more people, to get more benefits, more features. So now, adjustable. If you see the word adjustable, what does adjustable mean? Okay? For example, this is can adjust it, but up and down. You can see it can move movement. Adjustable. But this is not really the best example. But I wish I did have a microphone. I mean, like this is adjustable. Okay? Yeah, adjustable. See? I can adjust it. I can do whatever. See? Adjustable. So that's what that means. Okay? You can adjust it up, down, wherever you want. Left, right, you name it. So adjustable. Be careful. In adjustable life insurance, this is one exception to the rule. Okay? That's an exception. You can just make it an exception. An adjustable life insurance can be a term. It can be a whole life. An adjustable life insurance can be a term. It can be a whole life. Well, that makes sense. Because if I have a level term, I can decrease it. I can increase it. Okay. That makes sense. So it can be a term insurance. It can be a whole life. Except if it is an adjustable term, you know there is no cash value. Once you see the word term, you know there is no cash value. That's how you got to understand this. If it is an adjustable permanent coverage, so you know there is cash value because that's a whole life. Okay? So an adjustable can either be a term or whole life. So now, into adjustable, I want you to know something. The insured, when you say the word insured, the one with ED, that's the client. That's the person their life cover. The insured typically determine how much coverage. That's when the person who want the policy, okay, I want to pay this much. I want this coverage. That's the insured choose that, those two options. I want to pay this. That's the amount I want to pay, such as $100 a month. Okay? And I want $100,000. That's the coverage. If you pick those two, the insurance company, which is the insurer, will determine the appropriate type. So that's when the insurance company says, okay, should I give you a term or should I give you a whole life? You cannot pick all three. So you pick two. You pick the face amount and the premium you want to pay. The company going to decide, should I give you a term policy or a whole life? Note, into the adjustable life insurance, put that in your notes. You cannot change the insured. Into an adjustable life insurance, you cannot change the client. You can change from term to whole life. You can change the premium up or down. You can change the face amount up or down, but you cannot change the insured. Make sure you know that. All right, so if I read those 3 bullets for you, increase or decrease, that's what I just explained anyway. You can increase or decrease the premium. You can increase or decrease the face amount, or you can change the period of protection. That's been from term to whole life. That's what I just explained to you. That's why it's adjustable. Another word you can put for adjustable, put flexible. Flexible. If I don't want to say adjustable, I can say flexible. Adjustable. Or I can say flexible. That's when it gives you some flexibility. It's flexible. You can adjust it up or down. Okay? Now, those type of policy also contain what we call conversion. Converting. When I say converting, conversion. When you say conversion, that's when you can convert. That's the only way. That's the only exception. Where you can convert from a term to a whole life. Where you can convert from a whole life to a term. Only if you have an adjustable. Any other option, you can't do that. That's the only way where you can convert. Because usually when you have a term policy, you must convert to a whole life. But that's the only exception. If you have a term here, you can convert to a whole life. And if you have a whole life here, you can convert back to a term. That's the only exception to the rule. Now, there is another key word you have to know on this thing. Even though if it is adjustable, if you planning you want to increase the coverage, you have to prove. Okay, usually require proof of insurability. That's another exception. That's the only exception now. If you have this policy, okay, and you want to increase it, and it's inadjustable, you have to prove that you're in good health. Test required. You have to do tests again. They have to get your medical records again to make sure that you are in good health. That's an exception to the rule. Okay? Okay, so that's done with adjustable. So, a universal life, that's where we're going to explain this. 2 types. There's 2 types of universal life. By the way, universal life is the most expensive insurance that you can buy from the whole life. A universal life insurance is the most expensive one. Now, universal life insurance, next to it put flexible premium. Flexible premium or adjustable life or adjustable premium. So when you have a universal life insurance, it's also known as flexible premium adjustable life. That's when you can adjust it. How do you explain what adjustable mean? That implies that the policy owner has the flexibility to increase the amount of premium paid into the policy. Or they can later on, they can decrease it. So you can adjust up or down. So now, let's say that you go to a test question. And they ask you so-and-so purchase a flexible premium whole life. What type of policy that person purchased? You don't pick universal? How you don't pick that? See, that's why I tell you to put the notes. Because if you know when you say with adjustable and flexible premium, if you know which type of policy that we're referring to, you can't miss it on the test question. Those are the key words I'm giving you as well. In fact, the policy owner may even skip paying premium. If you go on a test question, they say which type of policy that allow the policy owner to skip paying the premium. That's when you can skip paying the payment of the premium. You better pick universal. As long as there is enough what? Cash value sufficient. As long as there is enough cash value. So the policy not lapse. Because if there is not enough cash value, the policy gonna lapse. You cannot skip premium. But if there is enough cash value, guess what? You can skip the premium. The company say it's okay, you can skip it. Now you know that's a trick. Be careful, that's a trick. When they tell you to skip it, I know clients love skipping the premium, or they told me I can skip it. But do you know the rule when you skip it? When you skip it, it's a loan. They paid for you. From where? From your cash value. The money you were supposed to borrow from. Then you skip it? Okay, great. Oh, we're gonna pay it for you. Oh yeah, as a loan. Okay. Nan gane ma ya na konte bougon, na kontro devant. If you don't speak Creole, that's not for you. I'm so sorry. Okay, so that's what that means. They'll pay it for you. You can say it's okay, skip your premium. As long as you have money to cover it, you go ahead. Do your thing. But you better make sure there is enough. Once there is no more, you're gonna lose it. Alright. Okay. Oh, look at this. If the cash value is too small, that's mean there is not enough. That's mean it's not sufficient. The policy will expire. They didn't say terminated, but they say it's expired. That's mean the policy will be canceled. The policy will be terminated. Alright. I did not say it. That's what the book says. Since the premium can be adjusted, the insurance company may give in the policy owner choices to pay either two type of premium. That's the reason if you have an adjustable or a universal life insurance, you have two type of premium. Make sure you know that. And this is where client confuse and you let your agent mess you up. There is a minimum premium you have to pay. There is a target premium you got to pay. So now, if you go in the test question and they're talking about where would you find the minimum premium? Where would you find the minimum premium on a universal life? Where would you find the target premium onto a universal life? Does that make sense? Which policy allow you to skip premium? Universal life. Which policy have the flexible premium? Universal life. All right. So now, let me explain let me read it here because I know you're not going to read it. Most people, they're not going to read it. Okay, so I'm going to read it for you. I'm going to do you a big favor. The minimum premium is the amount needed to keep the policy in force for the current year. Paying the minimum premium will make the policy perform as an annually renewable term insurance. So when you make the minimum payment, okay, that means it keeps this policy in force for this year. So if the minimum is not enough, that's a problem. Now, there is a target premium. That's why when you have a universal life, you're going to see two types of premium in your policy. The target premium is the recommended. That's what the company recommends you to pay. For example, the minimum can be $30 a month. But the recommended, why they ask you to pay, let's say it's 50. Okay? You pay 30 minimum, 50 is the recommended amount. Pretty much that's what required. 50 required, minimum is 30. Now, because you saw, maybe in whatever what happened to you, you pay the $30. Okay, that's good. The policy will be active for every year. That's okay. No problem there. But now, if you send $50, $30 will go for the premium, the other $20 will go to the cash value. So if you just send $30 and that's all is to cover the annually renewable term insurance, zero go to your cash value. And if I'm lying on this part, somebody can go comment and then tell me it's not you. I didn't say that's what this thing says. I didn't say it. That's what it says. There's the minimum you got to pay. If you pay the minimum, you keep it for the current year. The target, keep it in force for the entire life of it. As long as there is cash value, because they will take from this. When you make the minimum, if there's not enough, they'll take from your cash value. Everything, there's nothing wrong there. But if there's not enough cash value, because you didn't pay your target premium, something wrong there. That's a problem. So know those two things. Very important. Where would you find a minimum premium and target premium? Universal life. Know this. If the insured skip a premium payment, if you skip, I did not say it. If you skip on a universal life policy, the missing premium may deducted where? May deducted where? From the cash value. The policy will not lapse. Of course not. There is money. There is cash value. Of course it's not going to lapse. But if there is no money, guess what's going to happen? It will lapse. It will lapse. That's when lapse mean terminate. Cancel it or close it, whatever you name it. A universal life insurance policy has two components. Know that. There's two components in universal life, even though it's a whole life. Okay? They didn't come with this type of policy too long because they want to compete with it. They come with this type of policy. The insurance component, that's mean part of it in insurance. Okay? Part of it is cash account. That's the cash value. They take the insurance and the cash account, they put them together. That's give you the universal life. Now look at this. The insurance component, so be careful now, of a universal policy is always, not usually, not often, not sometimes, always. Always what? Annually renewable term insurance. I did not say it. I explained what annually renewable term insurance mean. If you remember, before when I explained the term insurance, okay? Remember, is the annually renewable term insurance plus the cash account make the universal life insurance. Remember, they also use it for group insurance. So therefore, if something gonna renew every year and it's a term insurance, every year, what's gonna happen to the premium? Goes up. So when you send your $30, if it's not enough, if the next year the $30 you're supposed to send more money, so therefore at that point they will require you to send more money. That's why the target and the minimum premium comes in. So make sure you understand that. All right. Another word you gotta know. If you see a universal life insurance allow, okay, allow, that's mean they permitted. That's mean they allow you to a partial surrender. Partial withdrawal, partial surrender of the cash value. That's when you can take a partial withdrawal, a partial surrender. You don't have to cancel the policy completely. You can take a partial of it. That's why it's flexible. So if you go in the test question, they're telling you which type of policy that allow you to do a partial withdrawal, a partial surrender. Universal life. It was that simple. It was that simple. It was that simple. Now, there's two types. There's two types of universal life insurance. The two types, there's one that called option A. If you go in the exam, option A, or they can pull option B. Okay? But now, option A also can be option 1. Option B can also be option 2. So if you go in the exam, they say option A, or they call option 1, that's what that means. It's a universal life. So now, the way you're going to understand this, you see where you say IRS corridor. Okay? If you go on the test question, and they're telling you, which type of universal life insurance have a level death benefits? Option A. That's when the death benefit do not change. Which type of universal life insurance have a level death benefit? Option A. If they say which type of life insurance, universal life insurance that have an increasing death benefits. You see, one is level, one is increasing. Option B or option 2. Okay, option A or option 1 have a level death benefits. Option B have an increasing death benefits. If they ask you which type of universal life insurance have a corridor, option A. Option A, you see the word corridor. Okay, corridor. So, that's pretty much pretty good. So, if you have a universal life insurance, which one you have? When you say I'm reading your policy, if you're reading your policy, if I'm telling you what I check, if I see an A on it, I know it's option A you got, level death benefits. If I see a B, I know it's a level increasing death benefits. Now, On option B, put that in your notes. You can get both the death benefits and the cash value. So if they say which universal life allow you to get both the death benefit and the cash value, option B. Option B allow you to have both the cash value and the death benefits. That's why the death benefits is increased based on the amount of the cash value. That's why I say an increasing death benefits. We should have now. If you want a test question, listen to me, teammates. Pay attention here. They say so and so purchase a universal life insurance. Okay. They don't, just like that. They put A. They put whole life. B. They put universal life, or they just put option A. That's B. Option A. Remember A, whole life. Let me just do it. Example. A, they put whole life. The reason I'm doing this for you because I want to show you an example here. A, they put whole life. B, oh, how would they put that? How would they send that? Come on. B, they put option A. C, they put option B. D, they put corridor. And they're talking about a universal life insurance. Look at this. If they're talking about a universal life insurance, they question. And now they give you those. You have to pick which one is the right answer. I'm going to show you how tricky it is. Not that tricky, but you need to know that. Okay, if you're doing process of elimination, if he asks you what is a universal life, if they ask you what is a universal, it's a whole life. Okay, what type it is? It's a whole life. That makes sense. Now, if they ask you, they didn't ask you which type, they say which type of universal life they're talking about. Which type? If they ask you which type of universal life now, option A, it also means the same thing with option D. So D and A is the same, so it can never be the right answer. So you see, C will be the right answer. You see it? That's simple. So if they ask you which universal life insurance have an increasing death benefits, and they give you those options, you better put B, because A mean the same thing with D. Because the corridor is right here. It's an option A, you find the corridor. Where would you find the corridor? Option A. Where would you find the level death benefits? Option A. Where you find the increasing death benefits? Option B. There is no corridor here. Look. There is no corridor. Look, you see how this make the corridor here? Straight, straight, straight. Whoop. They make a turn. But this one doesn't. Which one allow you to collect both the death benefits? This one. Because, see, under option B, which is the increasing death benefits, the death benefits include the annual increase of the cash value. So that's mean every year, when the cash value goes up in option B, the death benefit increases. That's why it's option B that have the increasing death benefits. All right. Next, we're going to talk about what we call variable life. Variable whole life. Now, put that in your notes. Anything that is variable, you need two licenses. A life license and a security license. Anything variable, you need two licenses. Life and security license. And anything that variable does not fix. That's why we did mention that. So on a variable life insurance policy is referred to variable whole life. It's a level premium, and also the premium is fixed. But also there's an investment attached to it. Okay, there's an investment attached to it, sir. Those policies have a fixed premium and a guaranteed minimum death benefit. So if you have a variable life insurance, it starts with 100,000 That's mean the face amount can go below 100,000. But if the client die and the policy at 80,000, you still get the 100,000. You're gonna get the guarantee minimum. But now, if the face amount go to 150, but you start at 100,000, you're gonna get the 150,000. Okay, but you cannot get less. That's a variable whole life. That's the whole life insurance. Still have the cash value. Now, what you need to know about the variable whole life, the cash value is not guaranteed. Okay, cash value is not guaranteed. Now, on the variable whole life, know this. Put that in your notes. There is a separate account. There is a separate account in that. But on the fixed, there is no separate account. Okay. So now, what about the variable universal life? It's a simple thing. What they do, they take the variable plus the universal life. That's all that's saying. Okay. It's still a whole life policy, except it's a universal life insurance. It's flexible, but the cash value is not guaranteed in this one, but it's flexible premium. It's the same thing. They just take what they do. They take a universal life insurance plus this, and that's give me this one. That's all that's saying. So anything variable, you need two licenses, life and securities. So unlike the universal life insurance, most investment vehicle in a variable universal life policy does not guarantee return. Yes, because it varies. It does not guarantee the cash value. Now, you see, that's still whole life. They continue confusing the consumers. By now, you should be well confused. Right? But at the end of the day, is what I want you to get. When it comes to insurance, whole life or term, once you know there's three term, a level term, increasing term, decreasing term, everything else will fall under the whole life. So when you see the word variable, that's mean part of it is investment. So you need two licenses, life license and security license. Because of that, you have to register with FINRA, the Financial Regulatory Authority, FINRA. You have to register with FINRA. You have to be licensed with the state, get a life license, plus you have to have your investment license. That's what that's saying. So this is tested. This is tested. Okay, dual regulated by the state and the federal government. This is tested. Make sure you know that stuff for your exam. Okay, so you're gonna see the Security Exchange Commission, the SEC, they regulates the variable life insurance, also the financial, what we call FINRA, and the insurance department. So now I'm gonna give you these notes. So variable life insurance. You can write this down like that. Variable life insurance regulates by SEC, FINRA, and the insurance department. Okay? Insurance department. There you go. That's you need to know that. And you need both licenses. Both licenses require. Okay? Both licenses required, which mean life and securities. Okay? That's when you have now you don't have to register with SEC. You do not have to register with SEC, but you must registered with FINRA. You better know that stuff. Better know that stuff. Send that to you. So when you see anything variable, when we go talk about the annuities, once it's a variable annuity, you need both licenses as well. Okay? And anything variable, the cash value is not guaranteed. And that's why I'm putting those notes for you. Write them down. in a variable life insurance. Remember, I told you this is a full class, not a review class. Review, I'll be done, but this is not a review. That's why you gotta hang tight. In a variable life insurance, the cash value is not guaranteed. It's not guaranteed. Okay, the cash value is not guaranteed. Because, you need to know why. Because of this separate account. Because of the separate account. Separate account refer to the investment. Because of the investment. Investment fluctuates. Because the investment portfolio. That's why it's not guaranteed. But, however, let me use however in this word. However, the minimum death benefits. Oh man, I'm giving you good notes. The minimum death benefits. The minimum death benefits is guaranteed. Wow. Come on, who is this? Come on. Boom. This is, if you understand this, folks, you're good to go. All right. I don't know. I hope I can just copy this before. I hope I can copy the chat room. Maybe I'll put it in there. I'll see. If I can put it, I'll put under the video. I hope I can. Remind me if I hope I just don't end this thing. All right. So after that, you're gonna find an interest sensitive whole life. It's still a whole life. It's just sensitive with the interest rate. I'm gonna just go through this one quickly. Just the first phrase, and that's it for it. Interest sensitive whole life, also referred to as current assumption in life, is a whole life policy that provides a guaranteed death benefits to age 100. But the insurer set the initial premium based on the current assumption about the risk, interest, and expense. So therefore, it's sensitive to the interest. It's sensitive to the market. That means if the market goes up, it might goes up. Market goes down, it might goes down. Sensitive to the interest rate. The cash value will be sensitive to that. What about the next one? Index whole life. When you see the word index, okay? When you see the word index, they're referring to the S&P 500. What is the S&P 500? For your notes, that means the 500 top company in the US. That's the market. The S&P 500 refer to the S&P, the 500 top company in the US. So what happened is this policy tracked that index. When it tracked the index, if the index return more money, you have a chance to have more money in that cash value, and the face amount can go higher because of that. Okay, so the main feature of an index whole life, or what we call equity index whole life insurance, is that the cash value is depend upon the performance of the equity index, such as the S&P 500. Although it's a guaranteed interest rate, the policy face amount increases annually to keep up with the inflation. So if they ask you which policy that will allow you to keep up with inflation, an index will keep up with inflation. A variable life can also keep up with inflation. Anything variable can help protect against inflation. Inflation means when inflation goes up, you need more money. So if you have this type of policy, inflation goes up, your face amount goes up as well. Okay? Pretty much this is it. This is the key feature of that policies. Okay? And after that, you're going to combine what we call combination of plan, joint life. Okay? Those things that's something that I can cover quickly. Then after that, we're going to go to the annuity. But I'm going to give you at this time 5 minutes breaks. Then I'm going to come back because I have to finish the annuity session for you guys. Okay? So joint life. A joint life, it's a single policy, okay, that's covered like 2 or more people. It's a policy they put together, husband and wife, usually for husband and wife. What you need to know about joint life, first to die. The premium is based on the joint life age between the 2 people. They take an average of their age, husband and wife. And the death benefits is paid on the first death only. So once the first person pass away, the policy is done. They pay the first death, and this is it. First to die. Joint life, first to die. Joint life, first to die. You cover 2 or more people, but first to die policy. Know this, the premium rate on a joint life is determined by the averaging of the age of both insured. Okay? What about survivorship? Survivorship, on the other hand, is covered still 2 or more. But the difference is second to die. Last to, you see, last survivorship. Last to die. On your notes, this is what you put. Joint life is first to die. Survivorship, second to die, last to die. That's what that means. Okay? So he paid the death benefit on the last one. Let's say that the husband and wife, cover for a policy. If it was a joint life, they pay. Let's say the wife pass away, they'll pay the husband the death benefits. If the husband pass away, they pay the wife the death benefit. That's a joint life. If it is survivorship, okay, if it is a survivorship, when the husband die, they don't pay the death benefits. The wife have to die in order for them to pay the death benefits. Okay? That's a survivorship. So the survivorship, this is what you have to know. Joint life, first to die. Survivorship, second to die or last to die. Last survivorship. When you deal with survivorship, both of them cover 2 people. Okay? But one gonna pay the death benefits on the first one, whoever died first, but the other one gonna pay when the last one die. The second one die. That's survivorship. And those are tested. Those are tested. So, if they ask you, what about the premium? The premium on the joint life is less. Let's say, for example, I take John and Mary. If they decided they want to buy their own policy separately, because there is a couple like that. Sometimes the husband say, no, I'm not paying your policy. Or the wife say, I'm not paying your policy. Everybody get their own policy. You have your own account, whatever. If they do that, it costs them more money. Because they buy their own policy separately. It costs more money. Okay? It's good for the agent too. The agent make more money. It's good for the company make more money. It's just not good for the client. I'm just being real. Now, they say, no, listen, we're not doing that, honey. Let's do one policy as a joint life. So they do one policy. So now, if they buy their one policy, it costs less money. Costs less money. Why? Because if the husband is 50, okay, and let's say the wife is 40, they're going to take the average of the age, that will be 45. So it costs them less money. So it will be best they get a joint life. Now, also, the survivorship, the premium will be lower than the joint life. Why? Because when the first one die, they're not going to pay the death benefit, so they give them a benefit, they pay less premium. So less money in the joint life, the survivorship pay less, then is the joint life, then after that, the 2 individual, they pay more money. So a good rule of thumb, husband and wife, you should get joint life, not separate policy, because when you have a joint life, it costs you more money, is for the benefit of the family. So this is whole life. That is whole life. All right, so if you do have a question, put it into the comments, and I will stop this recording for now. If you do have a question, I will address it. But now, if you do have a question, I'll be more than happy to answer that.